Everyone, if you were still treating Trump's Greenland Photoshop as a joke these past few days, your account probably isn't laughing now. Just this past Tuesday, the global financial market experienced a triple kill in stocks, bonds, and Forex. The S&P 500 plunged more than 2%, a massive red candle wiping out all gains from earlier this year. Gold went crazy. After breaking $4,700, it continued to smash through $4,800 on Wednesday, constantly refreshing historical records. And what suffocated institutional investors the most was the bond market. The 30-year U.S. Treasury yield approached the life-and-death line of 5%, and the VIX Panic Index soared to its highest point since last November. Why was the market reaction so violent? You have to know, Trump has acted crazy before, and Wall Street's usual reaction was, ignore it. Because traders invented a term called the taco trade. Translated, it means, Trump always caves on. This was once Wall Street's tried and true immune system. Everyone bet that he only wanted leverage, betting that he wouldn't actually smash the market. But this time, the immune system failed. When the White House spokesperson toughly stated there is no turning back, and when Danish pension funds publicly announced clearing U.S. debt, Wall Street suddenly realized he's for real this time. That familiar transactional president is gone, replaced by a geopolitical madman willing to sacrifice the dollar's credit for a Monroe Doctrine 2.0 map. Consequently, the taco trade died instantly. The market switched from spectator mode to escape mode. But if you think this is solely Trump's fault, you are looking too shallowly. This financial tsunami of selling America actually has two epicenters. One is in Washington, and the other is in Tokyo. Look at Tuesday's most terrifying data. The yield on Japan's 30-year government bonds soared by over 25 basis points in a single day. What is this concept? This is a tsunami in the bond market. The cause was the aggressive fiscal plan of Japan's new Prime Minister, Sanae Takaichi, which triggered fears of a Japanese fiscal collapse. What does this have to do with us? Everything. Japan is the world's largest holder of U.S. debt. When domestic bond yields in Japan soar, the yen carry trade that has supported global asset prices for decades begins to reverse. Simply put, Japanese capital realized, it turns out if I bring my money back to Japan, not only is the interest higher, but I also don't have to worry about Trump confiscating my assets. This is the underlying logic of the out-of-control U.S. bond yields. The Greenland crisis is the fuse, and the Japanese bond crash is the accelerant. The superposition of the two created a perfect liquidity black hole. In the face of this black hole, the AI faith of Nasdaq and Nvidia's earnings expectations appear pale and powerless. The most ironic scene occurred. In times of crisis, everyone is supposed to buy us debt for safety. But now, Danish pension funds are telling us, U.S. debt itself is the risk. The reason is, the U.S. government's finances are unsustainable, and the credit risk is huge. When U.S. debt, the world's largest safe asset, is labeled unsustainable by institutions, what we face is no longer a simple correction, but a reshaping of asset pricing logic. Where can the money go? Look at gold at $4,800. Look at the defense stocks being snatched up. Capital is voting with its feet, choosing the new arc in troubled times. Even more fatal is that the person everyone expected to hit the brakes, the Supreme Court, just dropped the ball too. On Tuesday, the Supreme Court did not make a ruling on the tariff case. The next window, in a month. This means the market has to run naked in no man's land for a full 4 weeks. In the following part, we will dismantle what kind of fishing will occur in the financial market during this long garbage time. Since the taco trade is dead, since the court is in recess, since Japanese capital has withdrawn, how do we ordinary people survive this driverless crisis? Many people still think the crash on Tuesday was because everyone is worried about war. Wrong. Wall Street isn't simply afraid of war. Sometimes war is good for the defense industry. What Wall Street fears is logic reconstruction. For the past 3 months, the reason U.S. stocks could hit new highs was entirely due to one, breath being held, Fed rate cut expectations. But this week, Trump personally pulled this oxygen tube with that map and the accompanying tariff threats. Let's dismantle this suicide chain to force Denmark to sell the island. Trump announced the imposition of 10% to 25% tariffs on European allies. In macroeconomics, this is not just diplomatic pressure, but the charging horn for imported inflation. Once tariffs land, the price of imported goods rises, and the CPI data that was cooling down will immediately turn upward. At this time, does the Fed still dare to cut rates? It doesn't, even as predicted by Jeffrey's strategists. If the situation spirals out of control, the Fed may be forced to maintain high interest rates for longer. This is the truth behind Tuesday's U.S. stock crash, not because of the fear of losing Greenland, but because the dream of rate cuts is shattered. When the liquidity expectation for 2026 changes from easing to tightening, those lofty AI valuations instantly lose support. But tariffs are only the visible knife. What really caused bond traders to completely break down on Tuesday was the backstab from the East. Please remember this figure. Japan's 30-year government bond yield soared by over 25 basis points in a single day. Why can this number scare us debt into collapsing? Because Japan is the largest overseas holder of U.S. national debt. For the past few decades, the operation of the global financial system has relied on a game yen carry trade. The Japanese borrow zero-interest yuan domestically to buy high-interest US debt, making money lying down. But now, the game is over. Because domestic yields in Japan are soaring. Coupled with worries about Prime Minister Sanae Takaichi's aggressive fiscal stimulus, Japanese investors found, it turns out, if I bring my money back to Japan, the yield is also high, and there is no risk. So, we saw the scene on Tuesday. Japanese capital began selling US debt on a large scale, repatriating funds to Japan. This created a liquidity black hole, with no one taking orders in the US bond market. When the biggest buyer, Japan, turns into a seller, US bond yields have no choice but to skyrocket. This is why the 30-year US Treasury yield approached 5% on Tuesday. That was the result of liquidity being drained by Japanese capital. Besides Japan's passive retreat, there is Europe's active offense. The CIO of Allianz Global Investors said, "If I were an advisor to European governments, I would suggest creating some market volatility, because Trump cares about this very much." This is the highest realm of game theory. The Europeans saw through Trump's soft spot. The stock market is his face. The scoreboard he uses to show off his political achievements. Trump was still bragging about his first-year achievements at the White House on Tuesday, and the stock market immediately gave him attitude. So, this kind of crash, to some extent, might be something Europe is happy to see, or is even manufactured. Europe is using capital weaponization to tell Trump, "You want to use tariffs to make us hurt. Then we will smash your stock market and make you hurt more." This is a negative-sum game of mutual harm. What is the cost of this game? It is credit. The Danish pension fund has already fired the first shot, announcing the clearance of all US government bonds before the end of this month. Their reason is no longer a euphemistic position adjustment, but points directly to the core. The US is not a good creditor. Its finances are unsustainable, and the credit risk is huge. When a sovereign-level pension fund begins to question America's solvency, this crisis escalates from a trade war to a credit crisis. This is why gold can rush to $4,800. That is the vote of no confidence cast by global capital against the dollar system. Next, we enter the deep water zone of this game. Since Europe has revealed the card of creating volatility, and since Japanese funds have begun to withdraw, what will Europe, holding $10 trillion in assets, do next? And for us, who have lost the protective umbrella of the taco trade, how should we face this breakless capital collision? The current market is no longer just about simple rises and falls, but a fundamental relocation of global wealth pricing power. For us, the biggest fear is not market volatility, but not knowing where the next wave of trillion-dollar capital flows will suddenly make a U-turn, turning what were originally safe zones into minefields. Therefore, we have internally compiled a stock bond triple kill safe haven map, which clearly marks out the chaotic funding faults and potential safe havens. I have placed this manual in the comments section. Click to claim it. Everyone, the most terrifying part of this game lies not in Trump's tariff stick, but in what is in Europe's pocket. According to the latest data from the US Treasury, the total amount of US assets held by the EU exceeds $10 trillion. This $10 trillion is the bomb hanging over the head of US stocks. Previously, we thought finance is finance, and politics is politics. But now, Deutsche Bank has issued the highest level of warning. This could escalate into the weaponization of capital. What does this mean? It means that if Trump continues to use tariffs to pressure, Europe may no longer play fair. They don't need to sell everything. Even selling just 5% of US debt or US stocks would mean $500 billion in selling pressure. For a fragile market that has just experienced a triple kill, this is not just a correction, it is an avalanche. Moreover, this is no longer a hypothesis. Europeans have pinpointed Trump's fatal weakness. He treats the stock market as a political achievement. Therefore, smashing US stocks is the most efficient bargaining chip in Europe's hands. So the question is Trump stupid? Does he not know this will crash the stock market? Of course he knows, but he did it anyway. And with a tough attitude, declaring there is no turning back. Why? Because he is playing a bigger game of chess, Monroe Doctrine 2.0. Look at the map. Greenland is not just a piece of ice. With global warming, it is the throat controlling future Arctic shipping routes. More importantly, it is the key pivot point for the Gold Dome missile defense system in Trump's vision. Coupled with the previous military operations against Venezuela, Trump's logic is very clear. He wants to completely establish absolute US hegemony in the Western Hemisphere by controlling Greenland and Venezuela. In the eyes of Trump and Rubio, this is a century-long strategy. In the face of this strategic goal, short-term stock market fluctuations, or even a quarter of economic pain, are costs that can be sacrificed. This is the typical gambler mentality of short-term pain is better than long-term pain. He is betting that before the financial nuclear bomb really explodes, Europe will blink first, will concede first. So, the current situation is very dangerous. This is a standard game of chicken. Trump is driving a car, Europe is driving a car, and the two cars are colliding at high speed. Wall Street's previous calculation was, they will slam the steering wheel at the last moment to avoid it. That is the taco trade. But the problem now is, Trump feels he is fighting for national security and will never yield. Europe feels it is fighting for sovereign dignity and will never compromise. Even the Danish pension fund has already jumped out of the car. Both sides seem to have removed their brake pads. Under these circumstances, we cannot pin our hopes on rationality, because history tells us that when politics takes command, the economy is often the first to be buried. Next, let's talk about the X factor that should have acted as a referee, but unexpectedly chose to be absent. Did the Supreme Court's delayed ruling buy time for this crisis? Or did it push it into a deeper abyss? Everyone, this Tuesday, traders all over the world were staring at the US Supreme Court. Everyone was waiting for the ruling that could settle the universe. Is Trump's tariff policy unconstitutional or not? The result? The Supreme Court chose silence. No ruling, no opinion. Even according to the latest schedule, the next possible ruling window will have to wait until at least February 20th. What does this mean? It means that when the global financial market needs rules and bottom lines the most, the referee has left the field. We originally thought today was the grand finale, either die quickly or live happily. But now, the Supreme Court tells us, don't rush, let the bullet fly for another month. This short 4-week recess is just a month for ordinary people. But for the capital market undergoing a triple kill, this is a full month of garbage time. During this period, Trump's tariff gun is still raised, and Europe's retaliation fuse is still burning. No legal force can yell stop during this period. Before this, Trump will, due to lack of legal constraints, intensify his testing of Europe's bottom line, and may even move against people at the Fed as rumored. Europe, seeing no hope for legal relief, will have to increase the intensity of capital retaliation. The market, having lost direction, will fluctuate violently in the face of every rumor like a headless fly. This is the situation Jeffrey's strategists worry about most. Even if an agreement is eventually reached, the long months of volatility in between are enough to shred investor confidence. This disorderly chaos is more terrifying than a single piece of bad news, because it cannot be priced in. So, please give up the fantasy that tomorrow will be better. The Supreme Court's delay has actually stretched the market's anxiety front by 4 times. In this month, the panic index VIX will not easily come down. Every piece of news about Greenland, every movement in Japanese bonds, will be infinitely amplified in this vacuum period. So, what should we do in this month-long no man's land? Since the referee is absent, since the rules are invalid, we must switch our originally aggressive offensive strategies to the most extreme survival strategies. Next, let's do a historical review. Actually, this script of political chaos plus market crash is not being staged for the first time in history. We need to see, in the special time window of a midterm election year, what bloody laws history has provided. Many people look at Tuesday's triple kill, look at the soaring VIX index and feel this time is different, thinking it's because Trump has gone mad. Don't panic. Stretch your vision back 80 years, and you will find this is just history rhyming. Since 1946, the US has experienced countless midterm elections. Statistics show that in these years, the S&P 500 index's average intra-year maximum drawdown is as high as negative 18%. This is an average. This means that in such a year, market halvings and crashes are the norm. Not falling would be abnormal. Why? Because the midterm election year is a reshuffling period for power. The current Greenland farce and the Supreme Court's delayed ruling are actually specific manifestations of this uncertainty. This negative 18% is the risk discount the market pays to cope with uncertainty. In the past month, Wall Street was immersed in the fantasy of the taco trade, and volatility dropped to its lowest point since 1990. This was actually abnormal. Tuesday's crash was actually the market returning to common sense. It is telling us, in a year of political reshuffling, volatility is king, and calm is an illusion. To understand 2026, we need to turn the clock back to 1997 to 1999. That was the previous supercycle of tech stocks, the starting point of the internet revolution. The market then was very similar to now. Technology was progressing rapidly, but the process was full of violent turmoil. In those 3 years, the market saw intra-year drawdowns, exceeding 10% consecutively. If you were there at the time, every day might have felt like the bubble was about to burst. But the result? The annual returns for those 3 years were all in double digits. We are now in a new round of supercycle driven by AI. Nvidia's computing power, Tesla's physical AI. These underlying productivity logics have not changed. The current volatility is growing pains. The large drawdown that may appear in Q1 or even Q2 of 2026 is not the beginning of a bear market. It is a standard deep squat. There is another, even more interesting logic. The current White House is actually more nervous about stock market performance than anyone. Just recently, the White House was high-profile bragging about its 2025 record. The S&P 500 hit record highs 37 times. In an election year, the stock market is the ruler's report card. What does this mean? It means that although Trump shouts no turning back and Europe is creating volatility, if US stocks really experience an avalanche-style decline, endangering voters' pension accounts, politicians, whether the White House or highly likely adjust their stance quickly or reach some kind of compromise. The tariff threat is more of a bargaining chip, not for mutual destruction. So, the panic at this moment is actually the countdown to building positions for smart money. When retail investors cut their flesh out of fear in the coming negative 18% pit, The real hunters are waiting for the lowest point of that deep squat. Then the final question is, in this chaotic world, what kind of weapons should we equip to both dodge this negative 18% drawdown and catch the historic rebound that follows? Next is our grand finale. I have prepared a highly operational survival guide for chaos for everyone. Everyone, if the retreat of Japanese funds causes US bond yields to truly stand firm at 5%, then the first shockwave in the market will be a brutal valuation kill. In finance, the risk-free rate is the denominator for all asset pricing. If the denominator gets bigger, the numerator must get smaller. So, the first survival rule, stay away from pure valuation assets. Even if it is an AI concept, as long as it is currently losing money, as long as its stock price is supported by a price-streams ratio, in the meat grinder of tightening liquidity, they will be sold off first. The second rule, avoid target assets. If the tariff war really starts, where's the disaster zone? Europe. The EU holding $10 trillion in US assets as a weapon also means it is itself a target. For those European export companies dependent on the US market, do not catch falling knives before the Supreme Court gives a clear statement on February 20th. Defense is just for living. Offense is for getting rich. Facing the uncertainty of the next month, we can build a double-headed betting strategy. On one hand, ambush retail giant stock, although the Supreme Court delayed. If the tariff is ruled unconstitutional in the future, or if Trump reaches a compromise as predicted by the Jefferies strategist, who benefits most? It is the retail giants with the largest global supply chains, such as Costco and Walmart. Once the tariff threat is lifted, their procurement costs will plummet, and profit margins will take off directly. For such stocks, the current panic decline might be a golden pit. On the other hand, lock in hard currency. If the situation spirals out of control, or as Jefferies is already doing, where will funds flock? Defense stocks, financial stocks, and gold. Look at gold, which has already broken $4,800. In an era where credit cracks appear, gold and silver are no longer simple commodities, but arcs in chaotic times. At the same time, pay attention to energy and mineral resources related to the Arctic Circle. Under the logic of resources are king, the rare earth and energy beneath Greenland will enjoy a strategic premium. Finally, and most importantly, a Bank of America survey shows that investors' cash holdings have dropped to historical lows, which is an extremely dangerous signal. In the first half of 2026, please be sure to maintain a cash position of 30% to 50%. Many people think cash will depreciate, but in turbulent times, cash is not trash. Cash is a hunting rifle. When the market experiences a negative 18% drawdown due to panic, when others are forced to hand over their chips due to liquidation, the cash in your hand is the most expensive bullet in this world. Don't rush to catch the falling knife. We have to wait for the knife to land, stick into the dirt, and stop shaking. Then walk over and pick up that blood-stained diamond. The ice and snow of Greenland will eventually melt, but the cracks in global credit can no longer be repaired. The opening of 2026 taught everyone a lesson. The death of the taco trade marks the complete failure of Wall Street's immune system. When the US treats tariffs as ransom for kidnapping allies, and when Europe treats capital savings as explosives for retaliation, we must clearly realize that warm, affectionate era of globalization that valued division of labor and cooperation has completely ended. The future world is a world where security overrides efficiency, a world where resources are king. In this year of clashes between gods, volatility is the norm and stability is a luxury. But please remember, chaos is also a ladder. Only on the ruins of the collapse of the old order can a new mansion of wealth be built. We are at the intersection of the disintegration of the old order and the reconstruction of new logic, and the market has entered a no man's land. Facing this complex situation where multiple liquidity black holes intertwine, seeing the underlying trajectory of capital relocation is more critical than blind operation. To help everyone find their direction in the fog of logical faults, we have compiled a stock bond triple kill safe haven map. It marks the new coordinates where global capital is currently assembling, as well as those critical points of credit collapse that are easily overlooked. I have placed this manual in the comments section. Click to claim it.